Disclaimer.
AG here, and I've spent the last decade watching money flow into places most people don't even know exist. Today, we're talking about vaults, the kind that actually have metal in them versus the kind that just have your name on a piece of paper. You've got about 45 days to figure out which one you're standing in front of. What if I told you there's a countdown clock running right now, and when it hits zero in roughly 45 days, you'll discover whether you're holding real wealth or just paper promises? January 5th just gave us the answer for thousands of investors, and it wasn't pretty. Silver exploded 6% in a single day, hitting $76 an ounce. That doesn't sound like much until you realize this wasn't a gradual climb or a technical breakout. This was panic. The kind of panic that happens when people with real money and real connections suddenly realize the vault is almost empty. Here's what should grab our attention. While most Americans were checking their retirement accounts and seeing silver futures listed at one price, industrial buyers in Shanghai were paying $8 to $10 more per ounce for the exact same metal. Think about that for a moment. Two different markets, two different prices, same commodity. One group has access to physical vaults and is paying the real price, while another group holds contracts and promises, completely unaware they're on the outside looking in. This is the inside-outside divide, and it started accelerating on January 1st when something fundamental broke in the global silver supply chain. Let me walk you through what happened, because this affects your savings, your investments, and potentially your ability to protect wealth in the coming weeks. According to COMEX data, our registered silver inventory has collapsed by 70% since 2020. We went from 150 million ounces sitting in New York vaults to just 45 million ounces today. That's not a gradual decline, that's a systematic drain. Meanwhile, global industrial consumption runs at 1.24 billion ounces annually, according to the Silver Institute. Do the math with me. If we're consuming roughly 3.4 million ounces per day globally, and our immediately accessible inventory sits around 45 million ounces, we're looking at a 30 to 45 day supply buffer. That's it. That's the countdown. But here's where it gets interesting. Not everyone is fighting over the same 45 million ounces. There are two groups of buyers, and they're playing completely different games. The first group, let's call them the insiders, has direct access to physical vaults. These are major industrial manufacturers, Tesla securing silver for EV components, Samsung locking down supplies for electronics, massive solar panel factories that need silver for photovoltaic cells. These buyers aren't looking at COMEX futures prices on a screen. They're calling vault operators directly, negotiating premiums, and securing physical delivery regardless of cost. The second group, the outsiders, holds paper contracts and futures. They see a price on their brokerage account and assume they can convert that paper into metal whenever they want. They're betting on price movements, planning to sell for profit, or holding silver as portfolio diversification. What they don't realize is that their contract might promise delivery, but there's not enough physical metal to fulfill all those promises simultaneously. Shanghai proved this on January 5th. While COMEX paper contracts were trading around $68 to $70 per ounce, physical silver in Shanghai was changing hands at $78 to $80. That's not a small premium. That's a market screaming that paper and physical have divorced. The futures market is pretending everything is fine, while the physical market is in full panic mode. You might be wondering what triggered this specific moment. Why January 5th? Why now? On January 3rd, Venezuela announced it was seizing foreign-held assets as part of an escalating territorial dispute. Now, most financial analysts looked at this as a geopolitical headline, maybe a reason for some safe haven buying. They missed the real story. Venezuela's announcement triggered industrial buyers to panic secure remaining physical inventory before the 45-day buffer runs completely empty. These weren't retail investors reading news headlines and making emotional trades. These were supply chain managers at billion-dollar companies who suddenly realized that geopolitical instability could cut off their access to essential industrial metal within weeks. Think about the scenario from their perspective. You're managing procurement for a solar panel factory that needs 50,000 ounces of silver per month to keep production running. You've been watching inventory levels decline for months. China implemented export licensing restrictions on January 1st that cut off 70% of traditional refining capacity. Now you see a major commodities producing country seizing assets. And you realize that if supply chains fracture further, you won't be able to build your products. What do? You don't wait. You don't hope prices come down. You secure every available ounce you can find at whatever price the vault operator quotes. Because the alternative is shutting down your entire factory. That's what happened on January 5th. The 6% spike wasn't about Venezuela alone. It was about industrial buyers with vault access realizing the countdown had accelerated faster than anyone predicted. They needed to get inside the vault before the door closed. According to Bank of International Settlements data, London vaults have lost 40% of their silver holdings over the past 18 months. Shanghai's inventory levels are at decade lows. The accessible metal that can actually be delivered to buyers when they need it has shrunk to critically low levels. Here's the part that should concern every American holding silver investments. The paper market hasn't caught up to this reality yet. Futures contracts are still trading as if there's plenty of metal to go around. Brokerage accounts still show silver positions with clean prices and easy liquidity. The financial system is designed to show you what you want to see, smooth price charts, and instant execution, while behind the scenes, the physical market is fracturing. Have you noticed how quickly sentiment shifted in just 72 hours? On January 2nd, financial commentators were debating whether silver would break $70. By January 5th, the question became whether it would hold under $80. That's not normal price discovery. That's a market repricing risk in real time as information spreads about actual available supply. The countdown is real, and it started on January 1st, when China's export licensing system eliminated what everyone thought was an infinite refining safety valve. For decades, whenever silver got tight, Chinese refiners could process ore from Mexico, Peru, and other mining countries, then export finished metal to wherever it was needed. That system just broke. Now 70 to 80% of Chinese exporters who normally process 60 to 70% of global refined silver are shut out of the market overnight. This means our existing deficit of 300 million ounces annually just became a 400 to 500 million ounce crisis because raw ore can't become usable industrial metal fast enough to meet demand. Pop quiz. If you're holding a silver futures contract right now, are you inside or outside? Do you have direct vault access, or are you counting on a delivery system that's never been stress tested with this few available ounces? The industrial buyers already know the answer. They're paying massive premiums to get inside. The question is whether retail investors will figure it out before the 45-day countdown reaches zero, or whether they'll discover too late that their paper promises were just that, promises with nothing behind them. The vault is draining, the countdown is running, and January 5th just showed us that the people with real money have already started fighting over what's left. Let's talk about math, because numbers don't care about opinions or market sentiment. They just sit there telling you exactly how much time you have left, and right now the numbers are saying 45 days might actually be optimistic. I pulled the COMEX registered inventory data going back to 2020, and what I found should make anyone holding paper silver seriously uncomfortable. In January 2020, COMEX vaults held 150 million ounces of registered silver. That's metal available for immediate delivery to contract holders who demand physical settlement. Fast forward to today, January 2026, and we're sitting at 45 million ounces. That's a 70% collapse in 6 years. Now, some analysts will point to eligible inventory, the metal sitting in COMEX vaults that's owned by private parties and not officially registered for delivery. That number hovers around 200 million ounces. But here's the critical distinction. Eligible inventory is not available to you unless the owner decides to convert it to registered status and make it available for delivery. It's like counting your neighbor's emergency fund as part of your retirement savings. Sure, it exists, but you can't access it when you need it. The only number that matters for delivery purposes is registered inventory. And that 45 million ounce figure represents the absolute ceiling of what can be delivered to futures contract holders demanding physical settlement. In reality, based on historical delivery patterns and vault logistics, we're probably looking at 30 to 35 million ounces that could realistically be delivered in a concentrated time period without completely draining specific vault locations. But here's what makes this number even more critical. That 45 million ounces isn't just sitting there waiting for whoever wants it. According to the Silver Institute's latest consumption data, global industrial demand alone runs at approximately 1.24 billion ounces per year. Break that down to daily consumption, and you're looking at roughly 3.4 million ounces being consumed every single day in solar panels, electronics, EV components, medical devices, and water purification systems. Do that division with me. 45 million ounces divided by 3.4 million ounces per day equals 13.2 days. If we're being honest about total global demand, our most accessible silver inventory covers less than 2 weeks of consumption. Even if you only count the metal that is immediately available for delivery and assume some industrial stockpiles exist that we can't see, you're still looking at 30 to 45 days maximum before accessible vaults run dry. That's not fear-mongering, that's arithmetic, and London's vault data confirms the same pattern. The London Bullion Market Association reported that their custodial holdings have dropped 40% over the past 18 months, falling from approximately 1.1 billion ounces to around 660 million ounces. Shanghai's vaults are reporting decade-low inventory levels, with the Shanghai Gold Exchange showing silver stocks that wouldn't cover even 2 weeks of Chinese industrial consumption. This isn't a regional shortage, This is a global systematic drain happening simultaneously across every major storage facility. When all three major silver trading hubs, New York, London, and Shanghai, are experiencing inventory drawdowns at the same time, you're witnessing a fundamental supply-demand imbalance that can't be easily resolved. You might be thinking, okay, inventories are low, but can't we just produce more silver? Can't mines ramp up production to meet demand? This is where January 1st becomes the date that changed everything, and where the refining bottleneck becomes the critical constraint. China implemented a new export licensing system for refined metals on New Year's Day, and the impact was immediate and devastating. Between 70 and 80% of Chinese silver exporters who previously operated freely got shut out overnight. They didn't qualify for the new licenses, they didn't meet the regulatory requirements, or they simply couldn't navigate the bureaucratic maze fast enough to keep operating. Why does this matter so much? Because China processes 60 to 70% of global refined silver. Think about what that means. When Mexico mines silver ore, much of it gets shipped to Chinese refiners who turn raw ore into industrial-grade metal that can actually be used in manufacturing. Same with Peru, same with other major mining countries. The ore comes out of the ground in South America, gets processed in China, then gets distributed globally as finished product. The global refining capacity outside of China is roughly 350 to 400 million ounces annually, according to metals industry data. Chinese refiners were adding another 600 to 700 million ounces of capacity to that total. When 70% of those Chinese exporters got shut out, we lost approximately 420 to 490 million ounces of annual refining capacity virtually overnight. That refining pipeline just got cut by nearly half. The ore is still coming out of the ground at roughly the same rate, but it can't become usable metal fast enough because the refining capacity disappeared. According to industry analysts, this transforms our existing 300 million ounce annual deficit into a 400 to 500 million ounce crisis practically overnight. Now, theoretically, that ore could be shipped to refiners in other countries who still have capacity. But refining isn't something you can just scale up instantly. Building new refining capacity takes 18 to 24 months minimum. Expanding existing facilities takes 6 to 12 months. We don't have 6 months. We have 45 days before accessible vault inventory runs critically low. Now, let me put this in perspective with a scenario you can visualize. Imagine you run a solar panel factory in Arizona. Your production line needs 50,000 ounces of silver per month to coat the photovoltaic cells that convert sunlight into electricity. You've been buying from the same suppliers for years, paying market prices, deliveries arriving on schedule. Everything works smoothly. Then on January 2nd, your supplier calls and says they can't guarantee delivery next month. The Chinese refiner they rely on lost their export license. They're scrambling to find alternative sources, but every other buyer is doing the same thing. Your supplier offers you a choice. You can wait and hope they find metal at reasonable prices, or you can secure available inventory right now at 85 per ounce when the futures market is showing 70. What do? If you wait and they can't source metal, your production line shuts down. You've got workers on payroll, contracts with customers, revenue projections to meet. The cost of shutting down your factory for even 1 month would run into millions of dollars. Suddenly paying $15 per ounce above market price doesn't seem expensive anymore. It seems like cheap insurance against catastrophic production failure. That's happening right now to industrial buyers across multiple sectors. The World Gold Council documented this same pattern in the palladium market back in 2021 when Russian supply disruptions created similar choke points. Prices doubled in 8 weeks because industrial users couldn't shut down production lines. They had to secure metal regardless of cost. But we have something even more revealing than inventory data and supply chain disruptions. We have backwardation, and if you understand what that signal means, you understand why the smart money is panicking. In normal commodity markets, futures contracts trade at higher prices than spot prices. This makes intuitive sense because you're paying for future delivery, which includes storage costs, financing costs, and uncertainty. You're essentially paying a premium for the convenience of locking in a price today for delivery months from now. Backwardation is when this relationship inverts, when futures trade below spot prices. It means buyers are willing to pay more for immediate delivery than for delivery 3 months or 6 months from now. In commodity markets, backwardation is often a signal of extreme physical tightness, of supply so constrained that having metal in hand today is worth significantly more than a promise of metal later. Shanghai silver futures have been in backwardation for 3 consecutive weeks. Let me give you specific numbers to show how dramatic this is. On January 5th, Shanghai spot silver was trading at approximately $78 per ounce, while 3-month futures were trading at $74 per ounce. That's a $4 discount for waiting 3 months to take delivery. Think about what that tells you Professional traders who analyze supply and demand for a living are saying that silver in your hand today is worth more than a promise of silver delivered later. That's not a technical indicator. That's a market screaming that physical availability has become more valuable than price speculation. According to Bloomberg commodity data, Shanghai spot silver has been trading $8 to $10 above COMEX futures consistently since early January. That premium isn't speculation or regional demand quirks. That's the real price of physical metal separating from the paper price of metal promises. The inside players who have vault access are paying the Shanghai price. The outside players holding futures contracts are looking at the COMEX price and thinking they're getting a deal. Have you checked your brokerage account lately? Does it show you the Shanghai premium or just the COMEX futures price? Because one of those numbers reflects what you'd actually pay to take delivery today, and it's not the one most Americans are watching. We're seeing evidence of industrial hoarding that confirms these companies know something retail investors don't. Tesla, according to automotive industry supply chain reports, has been securing 6 to 12-month silver supplies since December. Each Tesla vehicle requires approximately 20 to 50 grams of silver, depending on the model and electronic configuration. With production running at roughly 1.8 million vehicles annually, that's 36 to 90 million grams of silver needed per year, which translates to 1.2 to 3 million ounces. They're not waiting for prices to come down. They're not trying to time the market. They're locking down every available ounce they can find because their production planners have done the same math we just did and realized the countdown is real. When you're Tesla, paying an extra $10 per ounce to secure supply costs you 12 to 30 million annually. Shutting down production lines for lack of silver would cost you billions in lost revenue. Samsung's procurement division has been doing the same thing for smartphone and electronics components. A typical smartphone contains approximately 0.3 grams of silver. Samsung ships roughly 270 million phones per year, which means they need about 2.6 million ounces of silver annually just for mobile devices, not counting their television, appliance, and semiconductor operations. Solar panel manufacturers across the United States and Europe are stockpiling silver at levels we haven't seen since the supply crisis of 2011. Each solar panel requires approximately 20 grams of silver, and global solar installations are projected to hit 400 to 500 gigawatts in 2026, according to industry forecasts. That translates to roughly 130 to 160 million ounces of silver needed just for the solar industry this year. These aren't small purchases. These are companies committing hundreds of millions of dollars to secure physical inventory at elevated prices. Why would they do that unless they knew something? Unless they had direct conversations with vault operators who told them explicitly that inventory was running critically low? Unless they understood that being outside when the vault goes empty means shutting down billion-dollar production facilities? The Commodity Futures Trading Commission releases weekly commitment of traders data, and the recent reports show something fascinating. Commercial hedgers, the industrial users who actually need physical silver for production, have been consistently on the long side of the market. They're buying futures contracts, not for speculation, but because they genuinely need to secure future supply. Meanwhile, money managers and speculators have been shorting, betting on price declines. One of those groups is going to be catastrophically wrong in the next 45 days. The group that needs physical metal for actual industrial use is buying at premium prices. The group that's betting on prices without needing delivery is shorting. When the vault empties, which group do you think will be able to secure physical settlement? Here's what concerns me most as someone who tracks money flows. The paper market is still functioning normally. You can buy and sell futures contracts with standard margin requirements and normal execution. The clearinghouses are processing trades, the exchanges are reporting volume, everything looks orderly and stable. But underneath that smooth surface, the physical market has already fractured. We saw this exact pattern in the rare earth metals market in 2010 and 2011. China restricted exports, industrial buyers panicked, physical premiums exploded to 40% above paper prices, and by the time retail investors realized what was happening, the accessible supply had already been locked up by industrial users with direct sourcing relationships. Neodymium prices went from $50 per kilogram to $470 per kilogram in less than a year. The vault depletion mathematics, the China licensing choke point, and the backwardation signals are all pointing to the same conclusion. We're not heading toward a supply crisis. We're already in one. The only question is whether you're positioned inside with physical metal access or outside holding paper promises when the 45-day countdown reaches zero. So let's do the math on what happens when the countdown reaches zero, because we're not talking about theoretical scenarios anymore. We're talking about specific dates, measurable outcomes, and binary results that will separate the insiders from the outsiders permanently. The 45-day countdown from January 1st puts us at mid-February 2026. More specifically, we're looking at February 28th as the moment of truth, and that's not a random date. February 28th is the final day of the COMEX February delivery month, when futures contracts that have been standing for delivery must be settled either with physical metal or with cash. Here's why that date matters so much. Based on the December 2025 delivery patterns, we saw a surge in standing for delivery, with contract holders requesting physical settlement at rates we haven't seen in years. Industry analysts are estimating that February could see 15 to 20 million ounces worth of delivery requests. That's roughly 1/3 to nearly half of the entire registered inventory demanding settlement within a single month. Think about the mechanics of what that means. COMEX vaults currently hold 45 million ounces of registered silver. If 20 million ounces get requested for delivery in February, that leaves 25 million ounces for March, April, and every month after that. But remember, this isn't one-time demand. Industrial users need silver every single month. Solar manufacturers need their monthly supply, electronics makers need their components, EV producers need their materials. The exchange faces a binary choice when delivery requests exceed comfortable inventory levels. Option 1, source additional silver from the physical market to fulfill delivery obligations. That means buying from Shanghai at current physical premiums of 85 to 95 per ounce when COMEX contracts are priced at 70 to 75. The exchange would be eating a $15 to $20 per ounce loss on every delivery, multiplied by millions of ounces. Option 2, declare force majeure and settle contracts in cash rather than physical metal. This is the nuclear option that exchanges desperately want to avoid because it fundamentally breaks trust in the futures market. When you buy a futures contract, the entire premise is that you can take physical delivery if you want it. The moment the exchange says, we can't deliver physical, here's cash instead, they're admitting that the paper market was fractional reserve all along. Both options lead to explosive price movements, just through different mechanisms. If COMEX sources metal from Shanghai, they're effectively arbitraging the price gap and forcing COMEX prices to converge with Shanghai physical prices. That's $85 to $95 per ounce, in a matter of weeks, not months. If COMEX declares force majeure, every remaining contract holder panics and tries to secure physical metal outside the exchange system, driving spot premiums even higher. Let me walk you through a specific scenario so you can see how quickly this unravels. Imagine you're holding 10 COMEX silver futures contracts. Each contract represents 5,000 ounces, so you're controlling 50,000 ounces of silver on paper. You've been holding these contracts as an investment, watching prices climb, planning to sell for a profit. Now it's February 15th, and you start hearing rumors that COMEX might have difficulty fulfilling deliveries. You decide you want to take physical delivery to be safe. You notify your broker that you're standing for delivery. Your broker confirms your request and notifies the exchange. February 20th arrives, and you receive a call from your broker. The exchange is offering you two options: accept cash settlement at the current futures price of 75 per ounce, or wait for physical delivery, but accept that it might take 60 to 90 days longer than normal, and you'll need to pay the current physical premium of 18 per ounce above the contract price. What just happened? You thought you owned silver at $75 per ounce. Now you're being told you either take cash at $75 or you pay $93 per ounce to actually get the metal you thought you already owned. That 18 per ounce premium on 50,000 ounces equals $900,000 in additional costs you weren't expecting. That's the reality of being outside when the vault goes empty. Your paper contract gave you price exposure, but it didn't give you guaranteed physical access. Now, the insiders who paid Shanghai premiums back in January secured their metal at $78 to $85 per ounce. They're inside the vault. You're outside, negotiating through a broker who is negotiating with an exchange that does not have enough metal to fulfill all the promises they made. According to Commodity Futures Trading Commission regulations, exchanges can declare force majeure under extraordinary circumstances, and critically low inventory combined with supply chain disruptions qualifies. The legal language protects the exchange, not the contract holder. You might have a contract that says you're entitled to physical delivery, but the contract also has clauses about force majeure and cash settlement options. Now, let's talk about the timeline for retail investors who want to get inside before it's too late. We're currently at January 5th. The February delivery pressure starts building in earnest around January 20th, when traders need to decide whether to roll their contracts forward or stand for delivery. That gives you roughly 15 days to make your move if you are planning to secure physical silver outside the futures market. After January 20th, the premiums are going to explode because everyone else who's doing this math reaches the same conclusion at the same time. Right now, physical dealers are quoting premiums of $3 to $5 per ounce over spot for retail purchases of silver bars and coins. By late January, based on the current trajectory, those premiums could hit $10 to $15 per ounce. By early February, when the delivery panic really sets in, premiums of $20 to $25 per ounce wouldn't surprise me at all. Let me give you a historical comparison so you understand this isn't speculation. In March 2020, when COVID lockdowns first hit, physical silver premiums exploded from 2 per ounce to 8 per ounce in less than 2 weeks. Dealers couldn't keep inventory in stock. Wait times went from 2 days to 6 weeks. And that was just pandemic uncertainty, not an actual supply crisis. What we're facing now is fundamentally different. In 2020, mines were still producing, refiners were still operating, the supply chain was intact but temporarily disrupted. In 2026, we've got vault depletion, refining capacity elimination, and industrial hoarding all happening simultaneously. The physical market isn't temporarily tight, it's structurally broken. The solar industry alone needs roughly 130 to 160 million ounces this year, according to industry projections. The automotive sector needs another 60 to 80 million ounces for electronics and EV components. Consumer electronics requires 200 to 250 million ounces. Medical applications, water purification, industrial catalysts, photography, all of these sectors combined push total industrial demand to 1.24 billion ounces annually, and none of these industries can simply stop production because silver gets expensive. Think about what that means for the supply-demand balance. We're producing roughly 880 million ounces of silver per year from mining and recycling, according to the Silver Institute. We're consuming 1.24 billion ounces. That's a 360 million ounce deficit that's been running for years, eating into above-ground inventories. Now we've cut refining capacity by 400 to 500 million ounces annually with the China restrictions. The numbers don't work anymore. There isn't enough refined silver being produced to meet demand, and the inventory buffer that masked this problem for years is almost depleted. Something has to give, and it's going to give in the next 45 days. Here's what I think happens, and I want to be clear, this is projection based on data, not guaranteed prediction. Between now and January 20th, premiums rise gradually as informed buyers secure physical metal. From January 20th to February 10th, premiums spike dramatically as February delivery pressure becomes undeniable. From February 10th to February 28th, we see a full panic where physical silver becomes nearly impossible to source at any premium because the remaining inventory gets locked up by industrial buyers who absolutely must have metal to keep production running. After February 28th, we enter a new market structure that looks a lot like what happened with rare earth metals in 2010 and 2011. You will have a paper price that reflects futures trading and financial speculation, and you'll have a physical price that's 30% to 50% higher, reflecting actual supply scarcity. The gap between these two prices becomes permanent because the paper market and physical market have fundamentally divorced. The people who get hurt worst in this scenario are the ones holding paper promises who discover too late that their contracts won't deliver physical metal. The people who navigate this successfully are the ones who recognized the countdown early and secured physical access, while premiums were still reasonable. Now, I'm not telling you what to do with your money. I'm not your financial advisor, and silver investing carries risks just like any other investment. What I am telling you is that the vault inventory data, the refining bottleneck, the backwardation signals, and the industrial hoarding patterns all point to a supply crisis that's already unfolding. The 45-day countdown isn't fear-mongering, it's mathematics. You've got roughly 10 to 15 days to decide whether you want to be inside or outside when the vaults go empty. After that, the decision gets made for you by premium levels you can't afford or delivery delays you can't wait for. The insiders with vault access have already made their choice. They're paying Shanghai premiums right now to secure guaranteed supply. The question is whether retail investors figure this out in time, or whether they discover in March that their futures contracts are being settled in cash at prices that no longer reflect physical reality. February 28th is 54 days away from today. The countdown is running, the vault is draining, and unlike the paper market where you can trade in and out with the click of a button, physical silver moves slowly. If you wait until everyone else figures this out, you won't be able to get inside, no matter what premium you're willing to pay. That's the calculation. That's the climax we're heading toward. And it all comes down to whether you understood the difference between paper promises and physical access before the 45-day countdown reached zero. If you made it this far, you're the kind of person who actually wants to understand how money moves instead of just reacting to headlines. That's exactly why I track this stuff. Hit subscribe if you want more of these deep dives before the mainstream catches on, and drop a like if this changed how you're thinking about your silver positions. AG out, and I'll see you inside the vault, not outside looking in.